All right, next we're going to do question number 4. This one is on chapter number 7, Accounts Receivable. It's a very important question. This will for sure be on the super quiz number 2 and also on the final exam. You can expect a similar type of question, but obviously don't take my word for it. Teachers can switch up at any time. Let's dive right into it. So this company had the following balances on January 1st, 2020. So let's start off with January 1st, 2020. Let's update the chart. So they have accounts receivable for 120,000. And then they have allowance for doubtful accounts for negative 14,000. All right. So accounts receivable is the primary account. Allowance for doubtful accounts is the contra account. So a contra account is attached to a primary account and it reduces its value. So essentially, accounts receivable is a positive account because it increases on the asset side, and allowance for a doubtful account increases on the negative side and is negative because it reduces the value of accounts receivable. So if you wanted to calculate net receivables, you will simply take the 120,000 and add it to the negative 14,000 to arrive at $106,000. Because remember, accounts receivable is a primary account and allowance for doubtful account is a contra account. Now we have a bunch of transactions. Let's update these transactions in this chart over here. So transaction number 1, sales on credit for the year were $220,000. So in this situation, we're going to set up a revenue account called sales revenue. And we're going to increase our sales revenue for 220,123,220,000. As this is on credit, we're not receiving cash for them. So we're going to update or increase our accounts receivable by that exact same amount. Now, transaction number 2, customers returned 8,000 merchandise for credit. Okay, so transaction number 2. So in this situation, so remember, let's kind of rewind. So in the prior video, I indicated to you guys that whenever we have a sale, it's a 2-part entry, revenues and expenses. So in this case, we're ignoring the expense transaction just because our main focus is on accounts receivable in this question, right? So if this question was a merchandising or inventory valuation, then the second part, which is the expense portion, which is cost of goods sold and inventory, is important. But for the sake of this question, we're going to ignore that because our main focus, once again, is on accounts receivable, allowance for doubtful accounts, and the accounts are related more specifically to this chapter. So customers are allowed to return inventory. That's part of business nature. But in this case, whenever they have a return, we're going to set up a contra account to sales, which is going to be called sales, returns, and allowances, right? So sales, returns, and allowances. So this is a contra account to sales. Remember, a contra account is attached to a principal account. In this case, it's sales revenue, and it reduces that balance. So in this situation, sales, returns, and allowances is going to increase, but it's going to increase on the negative side because remember, contra account is always a negative balance. So negative $8,000. And in this case, since we're giving, they're returning money to us. Sorry, they're returning the product to us. We're going to reduce the amount that they actually owe us by $8,000. Now, transaction number 3. Collections from customers of $180,000. So in this case, our cash is going to increase by $180,000. And by the same token, our accounts receivable is going to decrease by $180,000 because these customers paid us off. So we're going to reduce the balance that they're owing us. Now, transaction number 4. So now a customer comes to us and he's like, guys, you know what? I went bankrupt. I can't pay you guys. So write-off during the year is $16,000. That's what that means. So now we know with certainty that this person isn't going to pay us off. What we're going to do is we're going to reduce our accounts receivable by that amount. And now we're also going to reduce our allowance for doubtful accounts by that amount, because any write-offs goes directly to allowance for doubtful accounts. Keep that in mind. That's very important. So in this case, since allowance for doubtful accounts is going to be decreased, we're going to have a positive number, because remember, allowance for doubtful account is a contra account, which is a negative balance. Now on transaction number 5. Okay, let's just say, for example, transaction number 4, to say February 1st, the person came to us, I can't pay you guys, I went bankrupt, right? But let's just fast forward to March 1st. He's like, guys, you know what? I'm able to pay you guys $4,000, right? Even though you owe the $16,000, he's gonna give us $4,000. We're obviously gonna take it. Now, this is a 2-part entry, because if you think about it, we've eliminated the balance he owes us completely. We took it out of accounts receivable, so we have to put it back in now. So we're gonna increase accounts receivable by $4,000. And we're going to increase allowance for doubtful accounts by negative $4,000. Once again, this is negative because it's a contra account. A contra account has a negative positive balance. Don't let that trip you up. It's just the opposite. Then on transaction number 5, we've actually received the money because we collected $4,000, right? So in this case, we're going to increase cash by $4,000 and we're going to decrease accounts receivable by $4,000. Once again, to recap, collected $4,000 of previously written off accounts. We have to put it back in, which we're doing over here. We increase AR by $4,000, accounts receivable. And since this is not a write-off, we're going to reverse this for negative $4,000, allowance for doubtful accounts. And since we actually received the cash, we're going to increase cash by $4,000, and then we're going to take it back out of accounts receivable because we've actually received it now. Then they're saying that this company estimates his AFDA. AFDA stands for allowance for doubtful accounts. So this company estimates his AFDA balance at year end at 15% of accounts receivable balance of the accounts receivable balance. Okay. So what we're going to have to do now is we're going to have to calculate the totals. So let's calculate it for cash 180,000 plus 4,000, and that's calculated for accounts receivable. So 120,000 plus 220,000 plus negative 8,000 plus negative 180,000 plus negative 16,000 plus 4,000 plus negative 4,000. So 136,000. So I calculated accounts receivable because this is a balance that we need in order for us to answer this question. So the current balance in accounts receivable is $136,000. We're going to multiply this by the percentage, which we're saying is 15%. And now to calculate the new balance in AFDA. So whenever we do this calculation, this is always a new balance in AFDA. So I'll explain that to you right now, what that means. So they're saying that this new balance over here is going to be negative 2,400. Very important. So let me color code it for you guys. This is a new ending balance in AFDA. Okay. So the current balance, let's calculate that right now, is going to be the negative 14,000 plus the 16,000 plus the negative 4,000, negative 2,000, and the new balance, which we just calculated, is going to be negative 2,400, right? 2,400, there you go. That means for us to get the negative 2,000 equal to the negative 2,400, we have to make an adjusting entry of the difference of these two. So to get that, we're going to do negative 2,400 minus negative 2,000 to arrive at negative 18,400. So the adjustment at year end, we're going to increase allowance for doubtful accounts by the negative 18,400, which is the difference. And then we're going to set up an account called bad debt expense. And we're going to increase bad debt expense by positive 18,400. So bad debt expense only comes into effect when we do the year-end adjusting entry. So we could double check our work, which is very important to do to see if we did it correctly. Let's calculate the balance here using these numbers. Negative 14,000 plus 16,000 plus negative 4,000 plus negative 18,400 gives us negative 2,400. There you go. So we double checked our work. We got it correct. So let's answer the following questions at hand. What is the accounts receivable balance at year end? This we already know in our chart. This is simply going to be $136,000 right over here, right? What is the balance that the company will set up in its AFDA at year end? We already calculated this as well. This is simply going to be the 2,400. Right? Remember, this has to be negative. And then for C, what is the amount that we reported as bad debt expense for the year? We've calculated this over here. Bad debt expense for the year is 18,400. So that wraps it up for this question. Very important question. It can get confusing. The biggest confusion lies in the new balance in AFDA and how to arrive at the difference. But remember, you could double check your work. So do it, right? So one of the common mistakes students make is they will add this instead, right? When they add this, they arrive at 22,400. So if you plug this into this over here and calculate the ending balance, negative 14,000 plus 16,000 plus negative 4,000 plus negative 22,400 equals negative 24,400. Okay, cool. That's a red flag because the new balance should equal negative 2,400. So you guys made a mistake there. Double check your work. Like easy marks, right? Easy marks. All right. Remember, practice this question. Very important. And yeah, next video, we'll tackle the last question.